Hello everyone and welcome back to the Business Boys Bodcast. As always, I'm joined by Kath and Hamza, and my name is Will. Today we'll be digging deep into comments made by Michael Sherb, Chief Executive at Appian Capital Advisory. Michael made multiple comments, but fundamentally mentioned that London should loosen the requirements on companies in the UK markets, particularly surrounding IPOs, and also that London should focus on banking and mining sectors and stop competing with New York on tech. So, on these comments, we'll be exploring some of the requirements it takes to get a company listed in the UK, why these may not be so attractive, why the UK is regionally powerful for tech investments, but not globally, and how the UK may be able to compete. Let's get into it. Kath, could you run us through some of the key requirements that companies need to meet to be listed on the London Stock Exchange?
Certainly will. So, the listing process in the UK is notoriously complex and costly, often acting as a barrier to entry for most firms. To list on the main London Stock Exchange, companies must meet certain strict criteria, including a minimum market capitalization of £30 million, significant free float obligations, and adherence to the UK corporate governance standards.
On top of that, companies are required to prepare extensive documentation, including 3 years of audited financial accounts, and incur substantial fees for listing and regulatory compliance.
Wow, that sounds like a big pain for companies, especially smaller ones. Hamza, how do these requirements impact businesses looking to access the capital markets?
Well, the tricky listing requirements often deter small to medium enterprises and high-growth companies from pursuing a listing on the main London Stock Exchange. Many find the process too time-consuming and expensive, leading them to seek alternative avenues for funding or even consider listing on other stock exchanges with more favorable regulations. But did you know that in 2021, the UK lost a major mining heavyweight from the London Stock Exchange?
The departure of BHP from the London Stock Exchange signaled challenges in the current listing requirements.
BHP's decision to abandon its dual listing in London and shift its main listings to Sydney highlights the hurdles faced by companies in meeting the tricky criteria of the UK stock market.
With requirements such as the minimum market capitalization of £30 million and significant free flotation obligations, smaller mining companies find it increasingly difficult to comply.
Furthermore, BHP's Australian shares tend to trade at a premium to its UK-listed stock due to lower tax arrangements there. This additional factor provided further incentive for the shift in its main listing to Sydney.
Recently, Michael Sherb, the chief executive of Appian Capital Advisory, told the Financial Times that London needs to loosen requirements to attract more mining companies.
BHP's moves, mining sector trends, and investors' concerns underscores the need for re-evaluation of listing requirements to attract and retain UK businesses in the UK market.
BHP's departure dealt a significant blow to the UK's mining sector and highlighted the urgent need for regulatory reform to retain key players in the market.
So what are the potential solutions to address these challenges? I understand that the Financial Conduct Authority, FCA, has proposed reforms to the UK's listing regime. Could you elaborate on this?
According to the FCA's consultation paper, the proposed reforms include simplifying the listing process, reducing the regulatory burdens, and enhancing the market competitiveness.
That sounds promising. By removing barriers to entry and fostering a more dynamic and inclusive market environment, these reforms could revitalise the UK's capital markets and position them for long-term success.
Additionally, the proposed changes include creating a new commercial companies category for equity share listings, allowing dual or multiple class share structures, and reducing the minimum free float requirement. These reforms are designed to create diversity, innovation, and investment opportunities in the UK market.
Absolutely, Hamza. By aligning the UK's listing regime with the international best practices and benchmarks, while maintaining market integrity and investor confidence, these reforms have the potential to attract a broader range of companies and investors to the UK market.
Interesting. Let's move on to tech. Based on a recent report published in January 2024, the UK's technology sector leads in Europe and ranks third behind the USA and China at a global level in 2023. UK's dominance in the European tech sector as of 2023 is a result of its raising more venture capital than France's $9.2 billion and Germany's $8.2 billion combined. In 2023, UK tech startups were valued at $996.8 billion, which was an increase from $988 billion recorded in 2022.
Well, this is interesting because those figures indicate a success of the UK tech economy and its outstanding performance as a source of global innovation from a technology standpoint, making it the European Silicon Valley.
Exactly, Will, and this is largely due to continuous investment leading to growth in the UK tech industry. Going back to 2022, the UK tech industry attained $1 trillion in value and was worth more than double Germany's $467.2 billion and triple compared to France's $307.5 billion. And of course, in terms of overall funding in unicorns and startups, the figures are outstanding.
Also, linking to Hamza's point, the increase in UK's funding of the tech sector produced 400 high-growth startups since 2000, all worth more than $250 million in value. These include 144 unicorn companies with valuations of $1 billion or more, and 237 futurecorns, which are fast-growing companies predicted to be the most valuable company.
I just can't say. I need to calm down.
Future
That was really good as well, but I just can't take FutureCon seriously.
The increase in UK's funding of the tech sector produced 400 high-growth startups since 2000, all worth more than $250 million. Linking to Hamza's point, the increase in UK's funding of the tech sector produced 400 high-growth startups since 2000, all worth more than $250 million in value. These include 144 unicorn companies with valuations of $1 billion or more, and 237 futurecorns, which are fast-growing companies predicted to be the most valuable companies in the next years.
But let's just say this aged like left out milk. The UK's efforts in keeping the tech sector at its highest performing levels were countered by that of the country's competitors in the stock exchange market offerings.
While London's efforts to attract high-growth technology companies have stalled with the chip designer ARM last year opting out for a New York listing, the city remains a global capital markets powerhouse for mining.
This increased preference for New York or Toronto stock exchanges comes from better pitches for valuations and the less tightened restrictions of AIM, such as the need to nominate advisors to ensure that companies are complying with the rules.
Thanks, Will. The recent decline in the tech sector was also largely due to the UK's economic instability, high inflation, and rising interest rates, which prompted tech firms to reevaluate their business strategies, adapt their growth plans, and revisit their staffing models. However, at the same time, we are seeing radical changes in the tech world after generative AI began to take control and lead the creation of new technology.
Will the tech industry see better times throughout the rest of 2024? We'll see, but with the current restrictions of the stock exchange, it's likely that companies will choose to go for London's exchange competitors, New York, Toronto, or Australia.
So let's dig deeper into one of Michael Sherb's comments that the London Stock Exchange and AIM markets should have looser requirements. Firstly, for those that haven't heard about AIM before, AIM is the alternative investment market and is a specialised unit of the London Stock Exchange. This exchange is typically used for small to medium-sized high-growth firms, with firms listing on AIM due to not meeting the requirements of IPO on the full London Stock Exchange.
That's right, Will, and these requirements can be quite strict, and a team will be needed just to help with an IPO on the London Stock Exchange. Here is a list of just some of the requirements and team members that are needed in an IPO transition. We can see lawyers, accountants, project managers, and lots of very complex tasks to prepare. All these parties will also aid in completing a prospectus which documents the transition.
Wow, that's a big team. It doesn't look easy to list on the London Stock Exchange. Kev mentioned some of these points earlier, but let's dig a little deeper. And to do so, firms will also reportedly need at least a £30 million valuation, have sufficient working capital for at least 12 months, have at least 10% of their shares made available to the public, have the last 3 years of financial information, have the Financial Conduct Authority approve the prospectus, have the London Stock Exchange approve the listing. The firm must then comply with UK corporate corporate governance code and pay initial listing fees and annual fees to the London Stock Exchange.
To pay initial listing fees and annual fees both to the London Stock Exchange and the Financial Conduct Authority. A firm of market cap £50 million would pay initial listing fees of around £90,000 and annual fees of £7,000 and have the possibility of additional fees occurring. Therefore, listing on the AIM market, which has no minimum requirements, seems a great alternative for small to medium-sized enterprises.
So Michael thinks some of these requirements should be loosened, and he may have a point. To IPO on the London Stock Exchange in 2021, a minimum market capitalization of £700,000 was needed. Arguably, then the rise to £30 million makes it so much harder for small to medium enterprises to get the full benefits of the capital markets London has to offer. Even though firms can still list on AIM, this may not provide the needed exposure, and there are more downsides. Firms listing on AIM need to appoint and pay for so-called nominators that ensure they comply with the rules, whereas neither rival exchanges for junior companies in Canada or Australia has such a requirement.
Thankfully, though, the FCA is removing the need for companies to present 3 years of audited accounts, so this could help firms get listed, particularly those with high growth that may not have 3 years of accounts. This move is similar to the Australian exchange ASX, which does have noticeably easier requirements and no need for 3 years of accounts. Looking at the AIM requirements, they don't seem too far off of the ASX, so hopefully some of the success can be replicated. The looser requirements of the Australian exchange has seen US tech become particularly fond of the exchange, with the flexibility being a bonus. So any moves in London Stock Exchange rulings that mirror ASX would seem to be a bonus.
That's right, Hamza. The relaxed rules do look to benefit capital markets, but let's hope this doesn't encourage any dangerous IPOs. ASX, after all, had relatively relaxed rules for industrial companies in the late 1980s, and this worked well to attract new listings, but ultimately created a liquidity crisis, which led to a 1987 market crash. So, although impressive, let's hope the London Stock Exchange doesn't do anything to ruin its nearly 130-year reputation. Well, that wraps up this episode of the Business Boys Podcast. What do you think of the capital markets in London? Should the rules be relaxed to encourage more investment? Let us know in the comments down below. But make sure to subscribe and hit that bell icon so you don't miss any of our latest videos. Also, check out our shorts, our TikToks, and our Instagram. Goodbye for now. Is it the lips smacking?
Say Betty bought some butter, the butter was bitter. Betty bought some butter, to make the butter better.
Yeah,
Betty bought some butter, the butter was bitter. Betty bought some better butter to bake the butter better.
I had a stroke there.
Save that.
You're going to have to write it down somewhere.
No, I don't want to waste what's left. And on we'll go through the wastelands, through the highways, till my shadow turns to sun rays. And on